Hello everyone and welcome. Today we are going to be demystifying a really crucial piece of the new Income Tax Act 2025. We're talking about Section 52. Now, if your business is dealing with those massive long-term expenditures, this section is basically your new best friend. It's the rulebook for how you claim deductions. So let's break it down together.
So let's just imagine this for a second. Your company has just poured crores of rupees into a huge merger, or maybe you've acquired a new telecom spectrum. The ink on the deal is barely dry, and the big question lands right on your desk. How much of that colossal expense can you actually deduct from your taxable income this year?
Now, I know your first instinct might be to claim the whole thing, right? But hold on, the tax law says not so fast. For these huge, long-term investments, you can't deduct it all at once. Instead, you have to spread that cost out. You have to amortize it over several years. You can think of it as matching the expense to the long-term value it's going to create for the business.
And this is exactly where Section 52 of the new Income Tax Act 2025 comes into play. It is the new, single, consolidated rulebook that governs the amortization for four very specific and very significant types of business expenses.
Okay, so here's our game plan for today. We'll kick things off with the big picture of Section 52. Then we'll break down the four key expenditures that it covers. We're going to look at the specific rules for corporate and telecom expenses, navigate that all-important transition from the old 1961 Act, and then we'll wrap it all up with a practical action plan for compliance.
All right, first up, introducing Section 52. And the main theme here really is about simplification and making things clearer for the future.
The biggest change with the 2025 Act is all about consolidation. Before this, under the old 1961 Act, you literally had to go hunting through four separate sections to piece all these rules together. Well, the new Section 52 streamlines all of that into one single cohesive provision. This makes the law so much easier to navigate and apply, which, let's be honest, cuts down on both confusion and the compliance headache. Okay, now for the real heart of the matter, the four key expenditures. Let's get into the specifics of what this new section actually covers. Now, the key thing to see on this slide is how it clearly lays out two very different models of amortization inside Section 52. And there's a really smart policy reason for this. For corporate stuff, like mergers and HR costs like VRS, it's a simple, fixed 5-year period. It just provides certainty. But for telecom assets, the period is variable. It's tied directly to the useful life of that spectrum or license. And that just makes perfect sense, right? It aligns the cost deduction with the period that asset is actually making you money. This distinction is absolutely crucial to understand. So, let's dive into our first category, corporate and HR expenses. We'll start with the more straightforward of the two models. For corporate restructuring in VRS, the approach is really simple. It's a 5-year straight-line deduction, 1/5 each year. The starting points are also crystal clear. The year the event happens for mergers and the year you actually pay the employee for VRS. But what's really important here is this principle of continuity. If a merger happens while you're in the middle of a deduction period, the new company just picks it up and continues the schedule seamlessly. No breaks, no recalculations. This is a key feature that helps M&A activity go smoother without creating a tax mess. Okay, Section 4. Let's switch gears and talk about the telecom sector, because this is where the rules get a little more nuanced. Now, to really understand the telecom rules, we first have to get this key concept down, actually paid. Section 52 is very clear on this. This isn't about when you book the liability in your accounts. No, it's about when the cash actually leaves your bank. That payment is the trigger for starting your deduction. But here's where it gets really interesting. You have to look at Rule 13 of the new income tax rules because it adds a critical detail. If a telecom company pays for its spectrum all at once, up front, it's simple. But if they choose a deferred payment plan, the law actually treats the entire upfront value of the spectrum as actually paid in year 1. This is a huge advantage, and it's designed to encourage investment in our critical telecom infrastructure. It lets companies start amortizing the full value right away, which is great for their financial planning and cash flow. All right, on to Section 5, transition and nuances. And I've got to say, this is probably one of the most important sections for every single practicing professional right now. So, the big question that's on everyone's mind, and this is taken right from the official FAQs, is this. What happens to all those deductions that started under the old 1961 Act? Do they just stop when the new law kicks in? And the answer, thankfully, is a very clear and reassuring no, they don't stop. Thanks to what's called a saving clause in the new Act, the transition is completely seamless.
Just look at this example. If you started a 5-year VRS deduction under the old law, you simply continue claiming the remaining 4 installments under the new Section 52. No disruption whatsoever.
Section 52 also packs in some other important rules, especially for the telecom guys. For instance, if a spectrum or license gets sold, the law has a clear way to calculate the final deduction or profit. And this is crucial. The law explicitly prevents any double dipping. You cannot claim both amortization under Section 52 times depreciation under Section 33 for the same asset. And just like with corporate expenses, that same principle of continuity applies if there's a merger or demerger.
Okay, we're in the home stretch. Section 6, Compliance and Key Takeaways. Let's bring all of this together into a practical plan you can use.
So, to make sure you stay compliant, here are 4 common traps you need to avoid. First, resist that temptation to claim 100% of the cost in year 1. Second, don't use the wrong amortization period. Remember, it's 5 years for corporate stuff, but it's the life of the asset for telecom. Third, don't forget the transition rules and accidentally stop a valid deduction. And finally, never ever try to claim both amortization and depreciation. It's explicitly not allowed.
So if you're going to remember just 4 things from our chat today, let it be these. 1. Consolidation is king. Section 52 is your new one-stop shop. 2. There are 2 distinct models, a fixed 5-year period and a variable asset life period. 3. The transition from the old act is seamless for ongoing deductions. And 4. Absolutely no double benefits, period. And that brings me to one final thought for you. The new law has definitely simplified the rules on paper, but does that really remove all the complexity? I'll leave you with this question to think about. What do you think is now the biggest practical challenge for professionals when it comes to valuing and accurately tracking these high-value, long-term intangible assets over their entire life cycle? Thank you so much for watching. If you found this explainer helpful, it would mean a lot if you could hit that like button, subscribe, and share it with your colleagues. And just a quick reminder, this video is for educational purposes only. Tax laws are complex and they're always subject to change, so please always consult with a qualified professional before making any decisions. This is an AI-generated educational video.